Welcome to Module 4 of Homewise Homebuyer Education, the online edition. In this module, we will discuss financing. Thanks for watching.
Let's get into financing and the loan process. This is, for many people, often the most confusing part of the home buying process because we're doing something we've never done before, securing a mortgage loan. And while you've been guided all this time by your home purchase advisor, your home buyer coach, and your realtor, now we're getting into this loan. Now we're getting into the documents where we are beginning to see what we are getting ourselves into in the best meaning of that word. So let's take a look and see some of the things that we can expect to come our way. There are many sources for you to get your loan. Homewise is just one option. So there are nonprofits like us. You can go to your financial institution, mortgage brokers, what have you. And we encourage you to shop around, see what might be available to you. In the world of loans and financing, there's a lot of new vocabulary, and I think that new vocabulary is part of what can add to folks' stress during this period. So let's go over some definitions together. We have some key terms for the informed consumer up here on the board. These are also in your handout if you're following along there or if you'd like to refer to them later. So we see them flying in here. So fixed rate mortgage, you've heard me mention that in our prior modules. A fixed rate mortgage is one in which the interest rate does not change over the life of the loan. This is the only type of mortgage that's offered at Homewise, and it's the only type that we would recommend that you get. There's also something called an ARM, A-R-M, which stands for Adjustable Rate Mortgage. Again, ARM stands for Adjustable Rate Mortgage. And an adjustable rate mortgage is a mortgage in which the interest rate can change based on different financial indexes. And that interest rate change will result in possible changes, either up or down, in our monthly payment amounts. This was a popular type of loan back in the 1980s when home interest rates were at historic highs. Folks were talking 13%, 15%, and all indications at that time were that interest rates were on their way down. So it made sense for folks buying at that time to get an adjustable rate mortgage because they were buying now while the interest rates were higher, but when that mortgage readjusted, say in 5 years, and the interest rate adjusted, it would readjust to the interest rate of the day, which would, they thought, right, be lower at that time, therefore lowering their monthly mortgage payment. However, now interest rates are at and near historic lows. So if I get an adjustable rate mortgage now, everything might be really solid right now with that low interest rate, but all indications are the rates will go back up over the coming years. So if the interest rate goes up, my monthly payment would also go up in the coming years. Points. All right, let's define points. A point is a percentage of the total loan amount. 1 point equals 1%. Okay? 1 point equals 1% of however much I'm borrowing. And this term points is often used to talk about any fees associated with buying the home. When you hear point, I want you to hear percent. So your lender might say, we charge 1 point for this. And what I want you to hear is, we charge 1% of the amount you're borrowing for this. So if you are borrowing $100,000 and your lender is charging you 1 point to borrow that money, they would be charging you 1% or $1,000 in that same example. So it sounds a little different, it can sound a little intimidating, but just keep in mind 1 point is 1% of however much you're borrowing or your loan amount. The next key term I have for you is the origination fee, and this is the fee paid to the lender that covers the origination, processing, and really just production of the loan application. The origination fee is one of the things that is discussed in points. So if you're talking to your lender, and especially if you're comparing lenders, knowing what their origination fee is will help you make your decision as well. You might have one lender lender that says we charge 1 point for our origination fee, and another lender that says we charge 2 points for our origination fee, right? 1% of your loan amount or 2% of your loan amount in those examples. And that can help you kind of decide where you are with those fees. Traditionally, this origination fee is part of your closing costs. If you're working with us here at Homewise, the vast majority of the time we're financing, we're rolling those closing costs into the loan. It's not more money that you need to bring up front. So it gets put into that loan, but that doesn't mean that I don't need to know why it's there, right? And how much it is. So knowing these definitions and what to keep an eye out for can definitely help empower us on this journey. The last definition that I have for you right here at the moment is the APR. APR, you may have seen that on credit cards, that sort of thing. And this stands for annual percentage rate. APR, or annual percentage rate. And the APR is a way to look at the total cost of a mortgage, and it's defined as a percentage of the loan amount. So discussed as a percentage of however much I'm borrowing. My APR, my annual percentage rate, is always going to be higher than my base interest rate, or the amount that we're talking about most of the time is that base interest rate. But the question is how much higher, and we'll look at where we want that to be in a second. But before we jump into those numbers, I'd like to give you a different example that might be a little bit easier to digest and understand, because APR can feel a little foreign to us. Let's talk instead about breakfast, something that we're all more familiar with. So if I go out to breakfast, I'm going to order a breakfast burrito, I'm going to get it smothered, Christmas, and what else is my server going to ask me, right? My server is going to say, oh, would you like a cup of coffee? And I say, yes, please. And so on my check when I get it, right, I have my burrito, I have my cup of coffee. What else is on that bill? Good, tax, and I'm also going to leave a tip. So let's say my burrito cost $8. My coffee's another $2. I'm up to $10. Tax is another $1. Let's say I'm up to $11. And then I'm going to leave, let's say, at least a $2 tip. I'm up to $13 for the cost of my breakfast, right? So my burrito still only cost $8. However, the total cost of my breakfast is up to $13. Keeping that in mind, my burrito is my base interest rate in that example. That does not change. But by the time we add on other fees, origination fees, and other loan costs, my coffee, my tax, and my tip, that gets me to the true cost of my breakfast, which was $13, or the true cost of my loan, which is my APR. I hope that helps clarify APR just a little bit. Let's take a look at that APR range that we want to stay within. We want our APR to be no more than 0.5% higher than our base interest rate. So anytime you've been meeting with your home buyer coach or home purchase advisor and even your loan officer at the beginning, you're always talking about this base interest rate, and it will be whatever it is. Today's example, we have 4.5. So I don't want my APR to be more than half a percentage point higher, which means that I don't want my APR to be more than 5% if my base interest rate is 4.5. If my base interest rate is 4.75%, I don't want my APR to be more than 5.25. The closer my APR is to my base interest rate, the less I'm paying for other things like other fees or other loan costs, right? The further my APR is from that base interest rate, the more extra stuff that is being added on there. So that's a way that you can compare loans and maybe see what will turn out to be better for you in the long run. Let's take a look and talk about how financing works with Homewise. We do things a little bit differently here. Most lenders are going to ask you to bring a 20% down payment. This is the traditional way in the market, so 20% of the house price. And it's if you bring less than that 20% that most other lenders are going to charge you that private mortgage insurance or mortgage insurance that we talked about in Module 1 that can potentially become part of our monthly payment. This mortgage insurance is an insurance that the lender charges that covers them in case you don't pay. It doesn't do anything for us as a homeowner. So to eliminate that mortgage insurance in To eliminate that monthly mortgage insurance with a loan here at Homewise, we structure our loans differently. So let's take a look at what that looks like. Let's say I have a $250,000 house price. As you can see, we're sticking with the same amounts throughout the modules. Homewise is going to make me a first loan for 80% of the home's value. In this example, 80% of $250,000 is $200,000. Next, Homewise is going to make me a second loan for the remaining 20%. So I end up with an 80-20 loan. In this example, 20% is $50,000. Right now, we're not taking into account your down payment. We're not worried too much about closing costs because that gets into the nitty-gritty. So kind of take those out of your mind for now and just stick with me on this broader example. If you have specific questions about your down payment and what that might look like, that's where your home purchase advisor or your loan officer will come in. The way that we make this work is that this first loan we make to you, and then we actually sell on the private market. We sell it to an institution known as Fannie Mae, which I like to think of as kind of our lender in the sky, all right? And we sell this loan to Fannie Mae because if we didn't, we wouldn't be able to make more than a handful of loans a year. We would run out of money, right? So to be able to help more people, we sell this loan off to Fannie Mae, but the important part for you to know is that we at Homewise stay on as your loan servicer. What does that mean? That means that all of your monthly payments come to us, all of your questions come to us. You can give us a call, shoot us an email, walk in our door, and ask questions about your loan, right? Or make a payment right here. So we stay on as your loan servicer, who you're in contact with about that loan. Now, in the traditional banking world, in the traditional mortgage world, you as the buyer would be responsible for bringing this additional 20%, right? The bank makes a loan for 80%, you bring the rest. But we know here at Homewise that for the vast majority of our clients, this is impossible right now, right? It would take us years and years to be able to save up enough to bring that 20% down payment. So we want you to be able to get into a home sooner, to begin building that financial stability and security that we know will serve you and generations well for many years. So we make you a second loan for that remaining 20%. That second loan is made out of something called our portfolio, which is money that we've borrowed to be able to make this possible. Because of that, it comes at a slightly higher interest rate than the first loan. It's usually 1 to 2% higher than the first loan, and that helps ensure that we can continue to borrow the money and make things work this way. You might be asking yourself, well, doesn't it come out to be more, right, for my monthly mortgage payment if this has a slightly higher interest rate? And what we've learned over our 30 plus years doing the work that we do here in New Mexico is that the vast majority of the time, even though we have these two loans with different interest rates, it will turn out to be a lower monthly payment for the majority of our clients than if we had added in that private mortgage insurance. However, if you'd like to see what that other option would look like for you, we can do that. It's possible for us to make loans with that monthly private mortgage insurance, but we've chosen to go this way the majority of the time. Again, if you'd like to see different scenarios, check in with your loan officer and they'll be happy to help. When you get a loan with Homewise, stick with me. You actually kind of have not just your PITI, like we talked about in Module 1, our monthly payment, our principal, our interest, our taxes, and our insurance. But we end up with our PITI. Okay? And it sounds a little funny, but here's why. As part of my monthly payment, as part of that $1,800 example that we saw in Module 1, I have my principal and interest on my first, I have my principal and interest on my second loan, and then I have my taxes and my insurance. And all of this whole PITI is already included in all of the numbers and estimates that you've been seeing over your time working with your home buyer coach and home purchase advisor. It's not until we get to this stage where we're working with our loan officer after we're under contract that we're going to see these really broken out, okay? So it's not going to be a surprise. It's not just going to be like, actually, we make the second loan and here's your additional $200 a month. No, it doesn't work like that, all right? This has always been programmed in. It's just now we're seeing that breakdown. One of the cool things about the way that Homewise structures our loans is that if you're making prepayments, which is paying more toward principal when and as you can to pay down your loan sooner, as we saw in Module 1, when you're making those prepayments, you can designate which loan you'd like them to go to. Yeah, you could split it up between both loans, that's great, or you can kind of attack one at a time. If you would like to attack one at a time, we highly recommend that you start with this second loan for a few reasons. You're probably already thinking of them. One of the reasons is that it's a smaller amount, right? Which means that I'll be able to pay it off sooner. Another reason is that it has a higher interest rate, so I'll be saving more money over the time period that I pay that off. Another reason is that as I pay this back, right, as I pay off this second loan, this money goes back into the Homewise portfolio, and that means that we can lend it out to another homeowner who comes after you. So in essence, you are reinvesting in another homeowner to come after you. And the fourth reason that we recommend that you pay this one off if you're making prepayments and focus it here on the second loan is that if you pay this off completely, guess what? Your monthly payment goes down as well because you've eliminated one of the P&Is in your monthly payment. So whereas you had principal and interest on the first and second loans and your taxes and insurance, now after paying off this second loan, you would have just your principal and interest on your first, your taxes and your insurance. So you can effectively lower your monthly payment simply by paying off one loan first without having to do anything like refinance. You may have also heard about down payment assistance. Let's talk about what that means. Down payment assistance does not take the place of your down payment. It's additional money that you might qualify for that may come your way to add to whatever down payment you're bringing. So for most clients, they're bringing this traditional kind of between 2 and 5% down payment, and any down payment assistance would be on top of that down payment that you would bring from your pocket, okay? Down payment assistance is based on a few criteria that are really important to know. One is your need. One is household size, household income, availability, because we get these buckets of funds and they're first come, first serve. And the last thing that down payment assistance is based upon is the location of the home. Sometimes we have down payment assistance from the city or the county, and depending on where you're buying, it may or may not be available to you. So it's not something that I want you to count on for this process, but it's something that I'd like you to understand. If we stick with our same $250,000 house price, our same first loan at that 80%, which in this case is $200,000, and let's say I qualify for $10,000 in down payment assistance, okay? This down payment assistance is not a gift. I wish it were. If you know of anybody making these gifts, let us know, because we have many people who could benefit from it. But this down payment assistance is not a gift. It's a loan at 0% interest. This loan is known as a silent second in the industry. And what that means is it's this loan at 0% interest that is not reflected in our monthly payment. So if I get $10,000 in down payment assistance, that means that I now only need $40,000 as my second loan to make up the rest of that $250,000, right? Because we have $200,000 plus $10,000 plus $40,000 gets us to that $250,000 price house. What happens is because this $10,000 in assistance doesn't have any monthly payment or any interest on it, we end up with a loan amount that's a monthly payment that is based upon the $240,000, not the $250,000 house price. So that's the way that down payment assistance will or can reduce our monthly payment, getting us the same amount of house. Again, it's all based upon certain criteria, timing, if you qualify, need, all of that criteria that I listed just a few moments ago. If you have questions about it, check in with your home purchase advisor, check in with your loan officer, and they'll be happy to answer questions specific to your situation. So you might ask yourself, well, when do I need to pay back this down payment assistance? What does that look like? Down payment assistance, if you receive it, works like any other loan outside of the fact that there's 0% interest and no monthly payment on it. But if I go to sell my house, take outside of this down payment assistance example, anytime I go to sell my house, I will be expected to pay back whatever remaining loan I have. So let's say I still owe $190,000 on my house and I choose to sell it for whatever reason. I will be paying back that $190,000 out of whatever proceeds I get from the sale to the lender, paying off that loan, all right? Now, outside of that, if I do have down payment assistance, that will get paid back as part of that, as part of whatever I need to pay back, whatever loans are owed. But if while I own the home, there's any of these changes take place, then I would also be expected to pay back the down payment assistance. So we've just discussed how I would need to pay back the down payment assistance if I sell the home. It was given to me to buy my primary residence. And anytime that's no longer the fact, that's where we're going to see this needing to be paid back. So if I sell the home, obviously it's no longer my primary residence. But if I rent the home out entirely, let's say, again there, it's no longer my primary residence, I would be expected to pay back the money. If I transfer the title to someone else, I will also be expected to pay back the money because it's not now my home, right? And this can potentially also apply to any changes you might make to the title. Again, check with us, your loan servicer, if your home is with us, to see what that might look like for you, as each down payment assistance program can have different criteria. And last but not least, the next time I would have to pay back the down payment assistance, or the other time that would apply, is if I refinance the home for cash out. That means I'm getting a new loan to pay off the original loan. That's a refinance. But the cash out part means that I'm accessing some of that equity, that I'm actually going to take some money out of the house to meet whatever needs I have at the time. And we'll discuss more about refinancing in Module 6. So I'd like to share some tips with you for the smart mortgage shopper, right? That's you now, because you're taking this course and we're in this together. So you always want to shop around, and it's important that as you're doing that, you want to look for an A paper loan. That means that it's going to be the best type of loan. You want to beware of any subprime mortgages, these B, C, or D paper loans. If it sounds too good to be true, it probably is. No money down, no monthly payment for 10 years, and here's your keys. Like, something's a little funky there. So, just really read the fine print. Always read the fine print, but especially when it comes to the type of loan you're getting, make sure that you understand everything. I always, throughout this process, not only taking notes during this class and bringing questions to our live Q&A session or giving us a call here at the office, but I always encourage you to ask questions throughout this process. So some of the questions that you might want to ask specifically during the loan application and the loan and financing part of the process is, can you explain that? How much does that cost? Who pays for that? Who does that benefit, and is that even required, right? So no matter which lender you're working with, don't be afraid to ask those questions and ask until you get the answer that you understand. I was lucky to sit in on one of our clients' loan applications when I first started my journey with Homewise as an employee, and I was so proud of this client because she asked the same question of the loan officer 3 times. And finally, on the 3rd time, the loan officer discovered a new way to answer that question, and it was finally in the context that the client could really understand. And if she hadn't kept asking, she would have just left not understanding, right? So I was so proud of both parties involved that they got there together. So please don't hesitate to ask. Great. Very good. At the time of my loan application, which will be with our loan officer, the loan officer is required by federal law to give us 2 documents. The federal law that runs this is the Real Estate Settlement Procedures Act. And the 2 documents that they must give us at the time of the loan application is a booklet called your Home Loan Toolkit, which most likely will come to you in a digital form, as well as the loan estimate. This booklet, your home loan toolkit, actually breaks everything down really well. It was created by the Consumer Financial Protection Bureau and is here to make sure that you understand the documents that we're about to go over. The loan estimate is the other, and that's the one that we're going to take a look at together. It will be easier for you potentially to view everything that I'm talking about on the loan document in the handout. So if you do have the opportunity to print it, go ahead and do that. But we've got it up on the screen here for you as well, and we'll look at it together. So our loan estimate is the best estimate that we can give you at this time as to your loan costs. And the loan estimate will include all costs associated with this transaction, both costs that are traditionally buyer costs and costs that are traditionally seller costs. So we're going to see everything. Just because it's on here doesn't mean that you, as the buyer receiving this, are necessarily the one who's going to be responsible for covering these costs, because we're going to see all costs associated with this transaction. We can, this loan estimate form will be the same with any lender in the United States for any type of mortgage loan. It's something that's federally regulated. So you can rest assured that seeing this form will happen with any lender that you decide to check out. You can see we have Homewise Inc. up here at the top. Then it says loan estimate. We have, we're looking at a real version of one of our clients, so we've taken out any identifying information, but we can see a date issued, applicant information would be your name and information there, property would be the address of the home that you will be buying, and then we have the sale price, which in this example here is $235,000. Over on this side here, we have the loan term, which in this example is 30 years, which is the most common. The purpose of this loan is purchase. The product is a fixed rate mortgage loan, which we've discussed, and then we can see a conventional loan type, and the interest rate has been locked, meaning it cannot change from this point on. Let's take a look at the loan terms. You're going to have a loan estimate for both of your loans. You'll have one loan estimate for your first loan, that 80%, and another loan estimate for that second loan, that 20%, like we saw earlier in this module. So we're only going to take a look at this client's for the first loan, because the second will look very similar. So when we take a look at that loan amount, we can see it says $188,000, and we have an interest rate of 5%. Both of those things give us a monthly principal and interest, just that P&I of $1,009.22. And then it asks the very important question of, can this amount increase after closing? And on all three of these it says no. That's a great indicator that we have a fixed rate loan. Also, I don't want a loan where that amount can increase after closing. If I'm borrowing $188,000, don't tell me that I now suddenly owe you $190,000, right? So that's a good check there to make sure that you're getting a solid loan. Next, it goes on to ask two questions. Does this loan have a prepayment penalty? And in this one, the answer is no. And does this loan have a balloon payment? Again, the answer is no. Let's define those two. A prepayment penalty would be an additional fee or charge that your lender might charge if you were to make prepayments or pay your loan off before the end of that 30-year term. Here in New Mexico, it is illegal for a mortgage to have a prepayment penalty. So if you're buying in New Mexico, this should absolutely be no matter your lender. What's a balloon payment? Have you heard of that before? A balloon payment, from my perspective, is a pretty dangerous type of loan. What it means is that I get a loan now, I make payments on it, and perhaps in 5 years, let's say, according to that loan, I now have to pay the whole remaining principal balance on that loan. So if I borrowed $188,000 this year, if in 5 years I have to pay whatever's left on it, maybe I've paid about $15,000 over those 5 years toward my principal. So now I would owe almost $170,000 in a lump sum. I don't know about you, but if I don't have that $170,000 available today, I'm probably not going to have it in 5 years either. And so that can be a very risky type of loan, and it can set us up for potentially losing our house. So again, we would encourage you to not get that type of loan and ensure that your loan does not have that feature. Next, we go into the projected payments section. So this is going to give us the payment calculation. We have a years 1 to 30 here in that payment calculation. That's another indicator that we have a fixed rate mortgage loan. We're going to see principal and interest of $1,922. That's pulled from above. Then we're also going to see that there's no mortgage insurance here because this is one of our Homewise loans. And then we have an estimated escrow of $196. That would be for our, you got it, property taxes and homeowners insurance. So that gives us an estimated total monthly payment of $1,205 for this loan. We can see down in this next section that we're estimating the taxes and insurance, and this estimate of $196 a month includes our property taxes and our homeowners insurance, as we saw throughout various examples, but especially in Module 1 when we broke down the monthly mortgage payment. We can also see that these are both in escrow, if you remember that custodial savings account that happens with most loans and always here at Homewise as well. That takes us down to costs at closing. So we have estimated closing costs in this example of $9,358, and then an estimated cash to close, or the estimated amount that I need to bring to the table to closing of $1,452. Again, all of these are the best estimate that we can give you at the time of your loan application. These numbers very most likely will change. The question is just which ones, and we'll take a look at both, not only this estimated document, but also the final document. Let's look at the next page. Page 2 of our loan estimate breaks down our closing costs, the costs associated with this transaction. As I mentioned, we're seeing costs that are traditionally seller costs and costs that are traditionally buyer costs because we're seeing everything associated with the purchase and sale of this home. Part A here is our origination fee. This is the cost of getting the loan. Once this is disclosed to me here, it cannot change if the loan amount doesn't change. Part B says services you cannot shop for. This is traditionally buyer costs. And Part C says services you can shop for, and those are traditionally seller costs. Again, everything is negotiable, so your contract and your loan estimate might look different. I'd like to break down parts F and G in a different way. And those parts are any prepayments and then an initial escrow payment at closing. So let's take a look. If I close January 3rd, 2020, when is my first mortgage payment due? January 3rd, no. February 1st, not quite. A mortgage is paid differently than rent. When I pay rent, I pay on the first of the month and I live in the house, right? I pay on the first of the month and I live in the house. A mortgage is paid the opposite of that. It's paid backwards, or what's known as in arrears. So what that means is that anytime I close in January, in this example we're talking about January 3rd, my first mortgage payment will take place March 1st, 2020 in this example, okay? Because I paid the month of March, and that's covering what? The month of February, because I'm going to pay in the house, or excuse me, I'm going to live in the house and then pay for it. So we can see that my March 1st payment, my very first mortgage payment, if I closed back in January, the principal and interest portion is going to pay for the month of February. But what about the remaining, 28 days that we have in January? Are they just free? Are they a gift? Because I worked really hard to get into my house. I wish, not quite, all right? We're going to be charged interest only for those, in this example, 28 remaining days in this year. And that's one of the things that we're going to see in Part F on that loan estimate. It's going to say prepaid interest, and it will be at whatever my interest rate is for however many days I have remaining in that month. That's just the way it works. The day of closing, I'm going to pay 1 full year's of my homeowner's insurance, that HOI, because I don't want to be in this house one night without homeowner's insurance, and the lender is not going to let me be in this house even 1 minute without homeowner's insurance to protect myself and the home. So at the time of closing, I'm going to prepay 1 full year of homeowner's insurance. In our example, that will cover me from January 2020 to January 2021. Okay? Again, this is part of my closing costs. This is not more money that I need to bring to closing because most of the time here at Homewise, this is financed into the loan itself. But it's important to know what that means, right? What are we talking about when we talk about closing costs? This is a lot of it. So here's my question for you. I'm paying 1 full year of homeowner's insurance, January 2020 through January 2021. When this date comes, January 2021, do I have enough money in, remember this escrow account, okay? Do I have enough money in that escrow account to pay for another full year of homeowner's insurance? If you remember, each month, as we make our monthly payment, 1/12, one month's worth of my property taxes go into escrow, and 1 month's worth of my homeowner's insurance goes into the escrow account as well. When the time comes to pay those bills, my loan servicer goes in to pay them. So when we get to January 2021, do I have enough in there? I should, right? All this was based upon projections. Let's say the price hasn't changed on my homeowner's insurance. I should, but I don't. This first year, and this first year only, I am short on my escrow account. Why? You guessed it, because I didn't start depositing in my escrow account until March of 2020. I didn't make an escrow deposit for my property taxes and homeowner's insurance in February, and I didn't make an escrow deposit in January either. This only happens the first year that I buy the home, so it's only the first year as part of my closing costs that I need to make an initial deposit into my escrow account. And that's what we find in Part G of the loan estimate. So I didn't make a deposit in my escrow account in the month of February, nor in the month of January, okay? So this is only in this first year. When I buy the home, I am 2 months short on deposits to my escrow account because I've only made 10, right? And I need 12. So only this first year, I need to make an initial deposit into my escrow account. That's what's going to happen in Part G of our loan estimate, okay? Is this initial deposit. It will be 2 months of my homeowner's insurance plus 1 for reserves. We always have a little bit extra in there, so you'll see 3 months of your homeowner's insurance. And how many months of property taxes we need to deposit is going to depend on when you buy the home. Property taxes happen on a very specific and special county schedule, so you may see 1 month, you may see 5 months, but again, your loan officer will have all of that figured out for you, and it will be reflected accurately here. Again, these are all part of your closing costs, and it can feel a little confusing, but it will all be calculated for you. However, ideally, now after this breakdown, you have a better idea of the numbers that you're looking at and what they mean. One of the cool things about the way this works is that when I close in my home on January, I'm moving in here pretty soon pretty close to the beginning of the month, so I don't have rent or mortgage in January, and I don't have rent or mortgage in February. I don't need to make that first payment until March. So this can be a really fabulous opportunity to shore up my emergency savings, to get that maintenance fund started, to recoup some of the savings that I needed to use for my down payment or moving expenses, anything like that. So keep that in mind, that it's a fabulous, fabulous opportunity not just to spend money, but to save that money. Because as a homeowner, stuff happens, and we'll talk about that more in Module 6. Let's look at the third page of the loan estimate. Additional information about this loan. So use these comparisons to compare this loan with other loans. This page of the document, for me personally, it can feel a little intimidating because there's some really big numbers on here. So comparisons. In 5 years, if I only pay my minimum monthly payments, not making any prepayments or anything like that, I will have paid a total of over $65,000 in principal, interest, any mortgage insurance and loan costs. And of that $65,000, I will have paid off just over $15,000 toward my principal, okay? Here on page 3 of the loan estimate is where we're going to see the annual percentage rate, that APR that we talked about. The whole rest of the time we've been seeing the base interest rate in relation to this mortgage. Here is where we see the APR. So the APR in this example is 5.119%. We're really getting into those decimals, and we'll break that down in a second. We also see here a number called the total interest percentage, which is the total amount of interest that you will pay over the loan term as a percentage of your loan amount. For these folks in that example, it's 93%. Holy cow, right? It can feel huge. But I remind you that this is the way that this works, right? I had been teaching this class for a couple years before I bought my own home, and still looking at this document for my own numbers. I took a deep breath. I took a little pause, but it's the way it works, and I know that, and I know what? That's right. I know that I can control these numbers by making prepayments, by committing to make those prepayments, whether it's $5, $75, one extra payment a year, whatever I can do to adjust these numbers. Deal? Deal. Let's get back into that APR. So we had a base interest rate on this loan application on page 1 of 5%. And we know that a good APR is less than 0.5 or half a percentage point higher than our base interest rate. So we want our APR to be less than 5.5 in this example. If we take a look, we've got a base interest rate of 5, and the APR on here, even though it's 5.119, we're not used to working with that many decimals, most of us, so I've taken the last two numbers off, and we're left with a 5.1%. So is this a good APR? It is, right? 5.1 is far closer to just this base 5% than our 5.5%. So again, the closer our APR is to our base interest rate, the less we're paying in extra costs, closing costs, any additional things the lender might be adding on, which we always want to ask about as well. So remember, we can affect these numbers. At the bottom of this form, we're going to confirm that we've received this document, and here's what it says at the bottom. By signing, you are only confirming that you have received this form. You do not have to accept this loan because you have signed or received this form. So you're just saying, I got it, it's in my hands, right? Ideally, you're understanding it because you've watched this, you've asked your questions, but don't worry about signing this, right? We're going to take a deep breath, commit to making those prepayments, and if you are shopping around, these are the two documents that you'll be comparing.
Thank you for attending Homewise Homebuyer Education, the online edition, Module 4. Return to the course page on our website to complete the required learning check before moving on to the next module. If you have any questions, please reach out at 505-983-9473 or email trainers@homewise.org.